Welcome back. Let's talk markets and where we're headed from here. Santosh Singh, fund manager at Motilal Oswal Asset Management, is with us on the show now. Santosh, morning. Thank you for joining in. Before we get to individual sectors, first, your view on the markets.
See, the markets, I think we are in a phase where we are not going to see big returns from the market. That's my view for some time, at least. At least for 6 months to a year, we are not going to see big returns unless and until we see such significant amount of policy changes happening. Now, because the valuations have reached a level where the EPS growth may not be able to keep track with the our expectations. So that's one part. And secondly, I believe that there are segments in the market where the valuations have gone slightly higher than my understanding of the market. So I would say I don't see a big decline in the market, but I don't see a big upside also in the market as of now.
Okay, so some of the valuations are concerning. Santosh, good morning. So in that case, I just wanted to understand the fund manager's perspective. In a market like this, where we're seeing sectoral moves, we are seeing peak valuations, what is the reason we are seeing so many sectoral funds come out? Is there still a pocket where fund managers are seeing a lot of valuation uptick still left? For instance, defense, for instance, you have the automotive space. What is your take here?
See, there are a couple of reasons why you're seeing sectoral funds, because you have seen these sectoral funds happening in the past also when the sector has been doing very well, right? And it's the government focus on those particular sectors sometimes which causes the funds to come in, because sectoral funds as such are also a bit volatile, and they can give you higher returns as well if the sector does really well. So what we are seeing is that the sectors where there is a lot of government focus and where the government wants to grow that focus for Indianization or something, then we are seeing some new funds which are coming up. And I think it's very focused on few sectors. It's not that we are seeing some large sector focused funds, right? Some of the largest sectors we are not seeing focused funds like IT or banking.
So in your portfolio, Santosh, where does technology stand? Are you neutral, overweight, underweight? And does TCS's Q1 performance change the narrative on IT from here on?
So, see, I tend to be slightly contra in my investing, so that my portfolio is slightly overweight IT, so that's one part. And then the reason is simple, that a lot of segments of the market we have already seen doing very well, and the valuations have gone ahead of my my levels where I can invest. So this is one sector which is a lot more driven by the interest rate cycles, the global interest rate cycles, and the global economic cycles. And we have seen that this is a sector which has seen significant de-rating over last couple of years. So my view is even a small bit, and then what you saw in TCS was not that I was not really excited by the results. It was not that it was out of the world. Right, but even a small bit of positivity is causing these stocks to go up like this. Simply because you have seen so much negativity over last couple of years in this sector when the market is going through on a daily basis making new highs.
And yeah, exactly. So that sequential recovery, that even slight outlook is something that the street seems to like. Is it the same case for Midcap IT? Where are you comfortable with valuations there, Santosh?
So again, Midcap IT has very different segments, right? What has done really well in Midcap IT are some of the product companies rather than really the software companies. So Midcap, and then this is one area where I think IT has been the only sector where Midcap and large cap has performed really differently. So in Midcap, I think if the growth rate remains where they were, right, because some of these companies have shown significantly higher growth rate than what we have seen across if the growth rate remains where they are, we might see the performance them doing well in future as well. But I would say that means if the cycle turns around, then it's better to be in the large cap than in the mid caps. If the expectation is that the cycle is still not turning around, then mid caps can still keep doing well.
But what is your view? Is the cycle turning?
So my view is that it might take another 1 year or so before that we actually start seeing a turn in the cycle. But the market tends to see only signs of it, right? When the downside also started, it didn't start when we see actually TCS reporting bad numbers or actually reporting we actually started seeing a downward revision. It started when we started seeing the interest rate yield curve getting in a different direction. And then if the interest rate yield curve again start seeing a rate cut, we might see the recovery happening in the sector later on, but the stocks might start doing much better before that.
That's about the IT space. The other sector I wanted to understand your take on was the energy space. We're seeing a huge surge. That has been the case. Again, when I talk about launches here, energy funds, they have been the talk of town again. How are you looking at the entire energy landscape? Do you think things are turning for the best here? What do you like, it be the gas utility space or the explorers and producers? What's your take?
Energy, if you see, there are three parts to it, right? The oil and gas part, the power producers, or the equipment suppliers. These are the various parts in energy space, right? And what you've seen is that most of the segments, from transmission to producers, everything has done really well over the last couple of years, and that's based on the expectation that there is going to be a revival, one, in the overall space. Second, the ESG concerns which we used to have on some of the producers, given that they consume coal, is gone off, right? From the time of Ukraine war, we are not seeing too much of ESG being talked about. So that concern and that discount has tended to gone off from this sector. And thirdly, we are seeing a lot of revival as well. So these stocks have done really well there as well. Now, if you ask me that from here on, I'm not too much comfortable with large bets in energy, given the sort of valuations they are.
Okay, so not comfortable with valuations. That's what I wanted to understand, because the general consensus also is that they're still trading at reasonable valuations. They are still lower than the 5-year averages that we've seen. At least I'm talking about the oil and gas space, not exactly the other power or the utility names as well. Santosh, your word on chemical space as well, because, I was going through a lot of reports which suggested that maybe recovery started right now. Our conversations with management have suggested that maybe the worst is over, but still it's not pricing into the chemical names yet. What is your take?
So let's get into the history of chemicals, right? Around 2010, we used to say that this is a 10-15 PE stock, right? This is what, because these are all commodities and they should trade at 10-15 PE. Somewhere closer to 2020, we started talking about that it should trade at 50 PE because these are specializations. And there is an away from China and India story coming in. And suddenly, for the last 1 or 2 years, the sector has not done well because the pricing has not been favorable to them. And also the demand, the supply scenario has not been favorable to them. Now what we are again seeing is that the pricing has started to recover a little bit. That's the sign which is getting, which is coming up, that the pricing has started to recover. And this is a sector which is a global sector, if you see that way. And so that's where, if this sustains, then we might see a recovery in this particular segment, because again, this has been a vast underperformer over the last couple of years, from a sectoral perspective. It has been underperformer over the last couple of years. So if we see a revival in the pricing and it's sustaining over next 6 months to 12 months, then we might see a good uptake coming here.
So are you overweight on specialty chemicals? Do you hold any of them? Because you are a contra player, as you said.
No, I hold a small quantity here. I don't hold large quantity. Yeah.
All right. So where else have you gone, contrarian to market perception?
I held a lot of health insurance.
Health insurance.
I don't hold any banks. So that's I hold very little.
So you don't hold any banks and you hold health insurance.
Yeah. So clearly the view is that for the best part of the market, the banking segment, which was the net interest margins increasing or the credit cost getting better. So we have seen the best part of that. And if the interest rates we see a cut in that the net interest margin at least can shrink from here on. And that's where I think we are not going to see the best of the earnings is behind us for maybe next 6 to 12 months. And my belief is that if the best of the earnings is behind us, we can wait for next 6 to 12 months before again getting into the banking. But at the health insurance side, if I look at, see, the companies are doing very well, but the stocks are doing very badly. So if the companies we have seen over a period of time that the stocks tend to only follow earnings, and that's my belief, and I tend to follow only earnings, and the stocks tend to follow only earnings. So if the earnings are doing so well, and if the stocks are not doing well, then it tends to give you a sense that in a market where everything is so expensive, you might rather want to be there.
Okay, we take that point. Santosh, it was a pleasure speaking with you. Thank you so much for joining us today with your perspective on the markets and individual sectors as well. Time for a break now. When we come back, we'll get you more on the markets on the other side. Stay tuned.